Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about inflation. More specifically, we're going to discuss the most recent CPI report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Of course, when we have a new CPI report, I like to go through some of the numbers so that we can unpack what's going on under the surface. Headline inflation did come in just below consensus. So going into this, consensus on headline was at around 3.1%, and you can see that it came in at 3%. Obviously, this is relatively good news for the Federal Reserve. They want to see inflation come back down closer to the 2% target. Of course, they don't care much about headline inflation. Core core PCE is what they're more concerned with. But it is at least good to see that headline inflation is coming back down. Note that we said earlier this year that as we get it, as we continue to push forward into the year, it's more likely that we see rapid disinflation as opposed to hyperinflation. Now, I still stick by that, but with that said, we also know that some of the comps from the previous year, right, if you look at the price of oil from a year ago, the base effects are no longer going to be favorable, at least for the next few months. For instance, the price of oil back in June, was back at 123, and so if you measure that out, say over a year time frame, it'll come down 43% or so. But as you measure it out from say July until July of the following year, so coming up this or whatever is going on this month, it might only be down 20 to 25%, maybe 25% or so, which is a big difference, than say 40%. So some of the base effects are no longer going to be favorable for the next few months. With that said, it doesn't mean that inflation can't continue to come down. It might not come down as quickly. It could just stay relatively flat for a few months. Demand, obviously, does seem to be trailing off, at least in some sectors. And so it's possible that we see it hang around this 3% level. If it goes below 3%, despite the base effects not being favorable, then that would be a sign that maybe the Fed has actually gone too far and the economy is in for a hard landing. Remember, the Fed the Fed is what they typically are the ones that, cause these hard landings because they raise rates too far and they break the back of the economy. And then the minute they start cutting, it's normally not enough. So with this in mind, you can see that the month over month change is actually the biggest descent we've seen during this disinflationary process. This is negative 1.04%, month over month. Now, this could represent the steepest descent month over month that we see during this disinflationary process, especially considering that the base effects from a year ago are no longer going to be favorable, right? We should see that across, various of the various measurements that we take. So we do need to keep that in mind, that inflation could get a little bit sticky at these levels. Remember, if you go back to the 1970s, it was actually right around this 3% level. Where it ultimately bottomed out, and coincidentally enough, this also occurred in July, right? In July is when it bottomed out at around 3%, and then it started to go back up, and then that ultimately led to another leg lower in the S&P 500. Now, arguably, the Fed would like to avoid this, and Powell has said as much many times, and so I do not anticipate the Fed to pivot anytime soon, because if they did, then they run the risk of repeating the mistakes of the 70s, where we basically just saw the S&P go sideways for the better part of 10 to 15 years. We don't want to see that, right? You don't want to see a period of higher highs and lower lows that lasts 10 to 15 years. I don't think anyone really wants to see that. And so the more favorable outcome, I think, would be to just stay higher for longer, or at least as long as they can with interest rates, to actually bring inflation back down to their 2% objective. So in the short term, I still think, we're likely going to see some level of disinflation over the next 6 to 12 months, but in the short term, it could level off for a little while and maybe become somewhat sticky. But I do not anticipate the Fed pivoting immediately, and so I don't think that we'll see inflation surge back up in the same way that we did back over here. I think it's more likely that it could pause for a little bit around that 3% level before heading down again. And if next month it comes in at 2.5%, then that shows that the Fed has probably done more than enough to actually get inflation back down to their 2% objective. Remember, it's not about just the rate. It's also about how long do they hold them there. There's an argument that maybe just holding at 5.25 would be sufficient to bring inflation back down. But we don't really know until it's probably too late. if you were to break down inflation year over year per category, it looks something like this. We'll zoom into the current day, and you can see that transportation, just like last month, remains deflationary. There's a difference between deflationary and disinflationary. So if I say it's disinflationary, we're still seeing rising prices. They're just not rising as quickly as they were before. If we say deflationary, it means that prices are actually going down. And you can see that transportation is actually at negative 4.67% year over year. Note that in the context of history, transportation is notorious for going deflationary at various times, while other sectors don't necessarily do it as frequently. But if we zoom in and we break this down by sector, right, so this is just headline inflation. You can, I mean, if you were just look at this, I mean, it looks like the Fed has done a pretty good job of bringing inflation back down. And arguably, if they just hold the Fed funds rate at 5.25, it might be sufficient to get us to that 2% level. With that said, it doesn't really matter what we think. The Fed is likely going with another 25 basis point rate hike at the July meeting. As you can see, a 92.4% chance of seeing another 25 basis points. And probably because core inflation is still remains relatively elevated. Now, if we were to break this down by category, you can see that food and beverages inflation continues to come down. Again, prices are still rising. They're just not rising as quickly. Once upon a time, they were going up by about almost 11% year over year. Now it's down to about 5.5% year over year. Housing, that had been sticky for quite a long period of time. It is now finally starting to come down. Apparel has been stickier than some of the sectors, at least at the levels it was at, but it has continued to drop here in the short term. If you go look at transportation, again, it has gone deflationary. If you look at medical care, it has been dropping relatively quickly as well, and it's actually close to going deflationary. If we look at recreation, it still remains relatively sticky, although I think that as we get into the latter half of the year, this should also come down as well. And so again, I mean, even though the base effects aren't going to be as favorable, you could see other sectors see rapid disinflation, and so maybe headline inflation will still come down. Education and communication, you can see that it was trending up back over here in the first part of the year, but now it started to come back down. And other goods and services has at least put in it's at least been a little bit disinflationary here, but all in all, it has been relatively sticky. So again, I mean, if you look at all of it, it is at least trending in the right direction, but arguably the Fed still has more work to do. Not necessarily in raising rates again, although I think that is the most likely outcome, but in keeping rates elevated for as long as they possibly can. I don't really think we should expect rate cuts in 2023. Maybe they'll come in 2024, but even that, it probably wouldn't be early 2024. Now, if you look at core inflation has been above 5% for the duration of this year, but fortunately, it is now finally coming down. It put in a 4-handle print, right? So, January came in at 5.55, then February was 5.53, then March was 5.6, then April came in at 5.54, May was 5.33, and now we're at 4.86. So this is at least a good move, right? I mean, it's a positive move. You can see that it has dropped off here, and arguably we want to see this continue to trend in this direction for several more months, as this needs to get closer to that 2% objective. And I don't really see the Fed pivoting anytime soon, as long as core inflation is still this elevated. Now, again, it's worthwhile to go check out, core PCE, right? So if you go take a look at core PCE index inflation year over year, you can see that it looks more or less the same as what we just looked at, but it only barely dropped off, right? It has still been around that 4 to 5% level for the entirety of this year, and it's probably one of the reasons why you don't see any changes here in the expectations of another 25 basis point rate hike, because the Fed is looking at this and saying, well, what progress has really been made? I mean, we're still at the same level that we were at, for basically the last year in core PCE. So with that in mind, what progress has been made, and if you look at a month-over-month change, you can see that it hasn't really moved. So again, the Fed will probably continue to raise. So all in all, I mean, it was a fairly good inflation report. We see headline inflation coming down. We see core inflation coming down. We see core PCE coming down, though not as much as the Fed would hope. And because of that, the Fed is likely to raise by another 25 basis points. That could end up being the terminal rate, but we'll just have to wait and see how inflation continues to play out as we go into the latter part of the year. If you guys like the content, make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time. Bye.